Wall Street woke to a jolt. JPMorgan Chase had reported unexpected losses, and the timing couldn't have been worse. In an election-charged market, losses never stay just financial. They become political. Traders instantly started attaching the story to one name that can move sentiment faster than data: Donald Trump. His return to the center of economic debate brought back old fears: tariffs, sudden policy shifts, pressure on institutions, and the kind of headline-driven volatility that turns clean forecasts into trash overnight. But inside JPMorgan, Jamie Dimon didn't look cornered. He looked like he'd been expecting the punch. As the stock dipped and recovered in violent rhythm, a leak began circulating across the street, a private operational blueprint, Dimon's volatility plan. It wasn't written like damage control. It read like a strategy for war. The losses were concentrated, but painful, exactly the kind of pain that makes the market wonder what else is hiding in the shadows. In public, JPMorgan called it manageable: valuation adjustments, reserves, normalization. Privately, the bank moved faster. Liquidity buffers were tightened. Marginal risk was trimmed. Counterparty terms were reviewed. Credit lines were watched like hawks, especially in sectors that depend on low rates and smooth global trade. The memo, according to people who claim to have seen it, described 3 phases. First, protect the core. Keep liquidity strong, raise reserves without spooking markets, and reduce exposures that could turn ugly if volatility stayed high. Second, absorb shocks: deeper hedging, faster portfolio checks, strict limits on fragile counterparties, and tighter discipline around corporate credit that had grown too easy in the easy money era. Third, go hunting. When others freeze, JPMorgan steps in selectively to win clients, buy assets cheap, and expand market share during dislocation. That last part wasn't what the public wanted to hear. It sounded like the bank didn't just expect chaos, it expected to benefit from it. Then the politics poured gasoline on the story. A senator's tweet framed the losses as Wall Street recklessness. A rival politician framed the criticism as election theater. Cable news panels turned the situation into a morality play before the market even had time to digest the numbers. And hovering over all of it, like a weather front that changes everything without asking permission, was Trump. Whether the losses were truly connected to him didn't matter. Markets don't trade certainty, they trade probability under pressure. Investors began to model Trump scenarios, the way they model interest rate paths. In one scenario, tariffs rise and inflation reaccelerates, forcing rates to stay higher for longer. In another, deregulation loosens guardrails, boosting short-term bank profits, but increasing long-term systemic risk. In another, the Fed's independence becomes a political battlefield again, rattling treasuries and raising the price of capital. Every scenario shared a common ingredient: volatility. And volatility is where banks either prove they're built like fortresses or find out they were wearing costumes. That's when a second leak appeared. A screenshot that looked like a calendar invite showing a scheduled contact between senior JPMorgan risk leaders and a political consultant tied to Trump World fundraising networks. It wasn't proof of wrongdoing. It wasn't even proof the meeting happened. But in an environment where trust is thin and narratives are thick, it was enough to change the smell of the room. The story stopped being only about bank losses. It became about alignment, about whether the most powerful bank in America was positioning itself for a possible new administration, and whether that positioning was influencing its public messaging. Dimon tried to kill the fire without pouring fuel on it. He publicly emphasized the basics. The balance sheet was strong, liquidity was strong, the bank runs scenarios because that's what responsible institutions do. But even careful language can misfire in a year like this. When Dimon said, "We don't run the country, we run a bank," half the public heard humility. The other half heard an admission that banks still sit close to the steering wheel. On trading floors, the conversation split into 2 realities. In the first reality, JPMorgan's losses were a warning sign. an early crack hinting at broader stress in credit, derivatives, or consumer risk. In the second reality, the losses were an intentional move, an accounting pain taken early to clean up exposure before the storm so the bank could play offense when weaker rivals retreated. The second reality was darker, colder, and uncomfortably more consistent with how big institutions survive over decades. Then something happened that didn't fit the panic narrative. While retail chatter screamed and TV graphics flashed red, patient money started buying. Not in a meme stock way, in a slow, methodical, institutional way, options positioning that suggested long-term confidence, bond market behavior that suggested counterparties still trusted the bank, flow patterns that looked like sovereign funds, and pensions making calculated allocations rather than emotional bets. It was quiet, but it was there, like a second heartbeat under the loud one. That's when the twist became clear. What if the leak was not an accident? On Wall Street, leaks can be weapons, yes, but they can also be signals. The memo didn't read like fear. It read like readiness. And if the right audience believed JPMorgan was ready for a volatility regime, then a losses headline wasn't only a negative. It was a repositioning story, a cleansing, a narrative reset, take the hit, show discipline, tighten the machine, then buy when others can't. By the end of the week, analysts began to change their language, not celebrating losses, of course, but reframing them. Concentrated pain, contained risk, proactive management. Corporate treasurers still treated JPMorgan as the safest first call when markets shook. Big asset managers still relied on its liquidity. Even rivals privately still respected its ability to operate when others hesitated. And Trump remained in the background of every calculation because that's what election year macro does. It turns one politician into a variable that touches everything: trade, inflation, rates, regulation, and the tone of institutional confidence. The irony was brutal. Trump's presence increased uncertainty, and uncertainty increased volatility, and volatility, handled correctly, created opportunity for the biggest and best prepared institutions. So the final twist wasn't a secret scandal, it was something colder than scandal, the possibility that the story everyone thought was about JPMorgan's losses was actually about JPMorgan's advantage. Dimon's plan, revealed, leaked, or strategically discovered, was less about surviving the storm and more about owning the map of the storm. In modern finance, winners aren't the ones who predict the future perfectly. They're the ones who build a system that survives multiple futures and gets stronger when everyone else panics. And as the market moved on to the next headline, JPMorgan didn't look like a bank collapsing under losses. It looked like a bank preparing to collect.